When looking for an investment that provides regular income, dividend stocks are usually the best solution most investors would turn to, especially monthly dividend stocks. Not only will they be paid dividends monthly, but they'll also get the benefit of averting various risks that come with the stock market. That in itself is already a great win. But what if you can buy all these different monthly dividend stocks with one transaction only? Well, as a matter of fact, you can do that too. Monthly Dividend ETFs is an exchange-traded fund which tracks the index of dividend stocks. In other words, monthly dividend exchange-traded funds will provide you with a steady income stream that'll help you build your wealth faster as well as diversify your portfolio. So today, we've come up with a list of 6 monthly dividend ETFs that are guaranteed to have high dividend yields and are definitely worth looking into. Hey, welcome to Stock Market Mate. Today we'll talk about monthly dividend ETFs with high dividend yields. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. An ETF, or an exchange-traded fund, is a type of investment which acts like a basket that contains a number of investments within, such as stocks, bonds, etc., much like a mutual fund. Some ETFs offer only US holdings, while others include international ones. Moreover, unlike mutual funds, ETFs can be sold on a stock exchange like a regular stock, which is why it is called an exchange-traded fund, because it is traded on exchange. In this case, a monthly dividend ETF is an ETF with mostly dividend stocks that pay monthly. Additionally, because it has multiple stocks within, dividend ETFs can be a great way to diversify your portfolio. Needless to say, having the best dividend ETF is also a great way to increase your income. Should one company go bankrupt by some unfortunate circumstances, the others can help minimize this loss. The monthly dividend income will likely increase higher over time, as mentioned earlier. So before we go take a look at the top 6 monthly dividend ETFs with high dividend yields, let's first have a quick discussion about what dividend yields are and how they work. Understanding dividend yields. A company's dividend yields is a measure of the amount of cash dividends paid to investors relative to the market value of their shares. To calculate it, you just need to divide the dividend per share by the market price, then multiply the result by 100. Usually, companies with high dividend yields pay major profit shares through dividends. A company's dividend yield is compared with the average of the business in which it belongs. Furthermore, to calculate the exact dollar amount that you will receive per share based on the stock's dividend yield percentage, all you have to do is take the dividend yield percentage and divide it by 100 and then multiply it by the current ETF price. With that in mind, let's move on and proceed to the list of monthly dividend ETFs with high dividend yields. As we go through them, you can also try to find the actual dollar amount based on the dividend yields of the dividend ETFs that we're about to introduce. Number 6. DHS, or WisdomTree.US High Dividend Fund. Counting down from number 6, we have the WisdomTree US High Dividend Fund, which is an ETF that monitors investment results of companies in the US stock market with high dividend yields. This ETF is great as you don't have to waste your time trying to research stocks with the highest dividend payments. As might be expected, this ETF has already done the job and all you need to do is purchase. And by buying this ETF's shares, you're basically giving target exposure to highest dividend paying stocks to your portfolio. For instance, among the 315 holdings that this ETF has, some you probably recognize such as Altria Group, Pfizer, Cisco, and Coca-Cola. The performance of this ETF is undoubtedly good as it holds a number of solid companies. DHS has given an annual return of approximately 11.57% throughout the decade, meaning that 10 years ago, if you invested $10,000 into this ETF, your investment would have grown approximately $30,000. This ETF offers a dividend yield of 3.77%, and that's not even the highest one yet. However, it is surprising to see how much this ETF has grown over the past decade for an ETF that pays a dividend over 2%. In terms of risk level, where 1 is the lowest risk level and 5 is the highest, DHS is a solid 3. Meanwhile, its expense ratio is 0.38%. You'll be paying $38 per year on invested $10,000. Most would say that any expense ratio that falls below the 0.5% is actually considered a cheap ETF. Number 5. SPHD, INVESCO and S&P 500 High Dividend Yield Low Volatility ETF. Next one we have SPHD. This ETF is based on the S&P 500 Low Volatility High Dividend Index, which tracks the performance of the 50 lowest volatility dividend-paying stocks in the S&P 500. Basically, this index was created as a basis for investors that are wanting to earn investment income. The current number of holdings in SPHD is 51. Such companies include William Companies, Kinder Morgan, Philip Morris International, etc. Moreover, SPHD was actually just recently founded back in 2012. Based on trailing 12-month dividend yield, the fund examines chosen stocks with sector weights capped at 25%. While SPHD resembles the broad large-cap market in that it is small-oriented, it is overweight by traditionally defensive sectors like utilities and basic materials. In addition, the fund may underweight volatile technology and consumer cyclical companies. Usually, the index is balanced twice a year. Its yearly return in the past 10 years is approximately 11.3%. meaning investing $10,000 back in 2012 today would be worth at least over $23,000. On the other hand, this ETF offers a monthly dividend yield of 3.86%. Risk level of SPHD would be 3 and expense ratio is around 0.30%, which makes it $30 annually on invested $10,000. Number 4. PGX, INVESCO Preferred ETF. PGX, or the INVESCO Preferred ETF, is based on ICE-B of AML Core Plus Fixed Rate Preferred Securities Index. Normally, this fund will invest in fixed-rate US dollar-denominated preferred securities which compose the index at least 80%. It tracks fixed-rate US dollar-denominated preferred securities performance which is issued in the US market. In other words, PGX invests only in the shares of preferred stock. Preferred stock is a constituent of share capital that has any combination of features which is not in common stock. This includes properties of equity as well as debt instruments like bonds. Preferred shares of stock also provide higher dividend yields compared to common shares. Currently, PGX holds 301 stocks including JP Morgan Chase, Citigroup, Bank of America, and others. For the past decade, PGX has had an annual return of about 6.73%. Its dividend yield is about 4.87%. Meanwhile, its expense ratio is 0.52%. However, due to its investing only in preferred shares, it carries a slight risk, making it also a 3 out of 5 on the risk scale. Number 3. Global X SUPERDIVIDEND US ETF. Low volatility and high dividend yield are the hallmarks of DIV. It can be used to track the entire US equity market and select stocks with large dividends and low volatility compared to index's benchmark. DIV holds about 50 of the highest dividend-paying stocks. This includes CubeSmart, Iron Mountains, and others. Since its inception in 2013, it has given 4.67% annual returns. In spite of its lower growth rate, this ETF is able to make up for the lack of growth with its high dividend yield. DIV offers a dividend yield of 5.80%, which makes it the highest one in our list yet. On top of that, its expense ratio is 0.45%, which is also high, and so despite having less annual return, it does have a higher dividend yield and expense ratio. It is, however, very risky, which means it is a 5 out of 5 in the risk scale. Consequently, the low annual return as well as the fact that it only invests in 50 companies makes it a little bit more of a risky option, which brings a few concerns. Number 2. SDIV Global X SUPERDIVIDEND US ETF. Number 2 on our list is the SDIV. This ETF looks at investment results which are in accord with the price and performance of yield before fees and expenses of the sole active global SUPERDIVIDEND index. At least 80% of SDIV's total assets are invested in securities of the underlying index and in American depositary receipts, and global depositary receipts based on those securities. This index tracks the performance of 100 equally weighted stocks, including those from emerging markets that yield among the highest dividends in the world. Similarly to DIV, this ETF is made by the same company with a slight difference, which is that DIV has a higher 5-year return than SDIV. Moreover, as mentioned earlier, SDIV invests in 100 of the highest dividend-paying stocks around the globe. This ETF holds 104 stocks with top companies including China Power International, NOS, Electric Consumer, and others. The annual return of this ETF over the past 10 years is approximately 3.10% on average. It currently has a dividend yield offer of 6.83% and pays a monthly dividend like every ETF in this list. Since this ETF invests a lot in international stocks, which provides higher volatility compared to stocks in the US, which is why it is a 5 out of 5 in the risk scale. Furthermore, it has an expense ratio of 0.59%, which is definitely a bit more expensive. Number 1. KBWD INVESCO KBW High Dividend Yield Financial ETF. Lastly, we have number 1, which is KBWD. With KBWD, you can gain access to banks and other institutions that offer attractive dividend yields. Although there is definitely a risk associated with KBWD, since the underlying companies mostly include less stable financial institutions. Therefore, this fund might not be suitable for those with a low risk tolerance, and the hyper-targeted nature of it may make it less attractive to those building a balanced portfolio. KBWD can, however, be a very attractive solution for those who are looking to add income to their portfolio, as the effective dividend yield may be greater than 10%. Moreover, this ETF is based on KBW NASDAQ Financial Sector Dividend Yield Index, which consists of companies providing financial services and products primarily in the US with high dividend yields. Though KBWD only holds about 41 stocks, which includes Orchid Island Capital, FSKKR Capital, and so on. These are companies that you probably won't recognize. Moreover, its annual return for the past 10 years is 8.75%. Its dividend yield is 7.37% with an even higher expense ratio of 1.24%. So while this ETF had the highest dividend yield in the list, it's also the most expensive and risky. And that pretty much wraps up our list of 6 monthly dividend ETFs with high dividend yields. You probably noticed how risky most of these are, which is why it's important that you consider knowing more about them before choosing which ETFs you want to purchase. Although they're pretty attractive options, they do have a few concerns that every investor must definitely think more about before deciding. All in all, if you do decide to purchase at least one of the options in this list, you'll find that your portfolio is much more balanced or diversified, and you'll definitely earn more income in the long run. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!